Right now, the market's been quite unusual in the way it's thinking about the trade war. All the investors in the US stock market seem to think it won't happen. They think President Trump just wants to negotiate, wants a deal, and ultimately he will come to a deal. You talk to investors in China, in the rest of Asia, talk to investors in Europe, and they're really worried. They don't trust President Trump, they don't understand him, they think he's walking himself into something of a corner, and therefore they're much more concerned about the impact on trade war. So we've really seen two different reactions to the trade war. Markets outside the US have continued to rise almost without any worries about it. Markets elsewhere in the world have been far more worried. So to us, that means that more of the opportunity, as it does for valuation reasons and other reasons, is in stock markets outside the US. The US market is not so concerned because when they hear President Trump say that trade wars are good and easy to win, and he says that manufacturing is only 12% of the US economy, it should be much more. The problem is that manufacturing, which is where the trade war would really bite, is 40% of profits of US companies. So if we do see real tariffs implemented, either that's going to cause market share losses for American companies or profit declines if they have to take on those tariffs. So that's a really important implication going forward, and so far it hasn't really impacted the US economy. What we're doing with the portfolio, firstly, we're already tilted away from the US. So to the extent this is a US versus China dispute, it doesn't mean that companies elsewhere in the world won't get caught up in it, but it means they're not really at ground zero for the conflict. It means that you've got to be very careful about the type of companies you're buying. And certainly we'd flag two areas of the global economy that are amongst the most globally integrated. One would be the tech sector. We all know that so much of when people buy an iPhone or a PC or whatever it might be, the components get manufactured often in Taiwan or Korea. The products get assembled in China and then shipped to the rest of the world. So the technology sector is one area that is potentially very hard hit by tariffs. The auto sector is another one, where again you've got global supply chains. We've come to some resolution, it seems, on the North American Free Trade Agreement, but elsewhere in the world that's still a concern, and we've seen announcements from GM shutting a number of their plants and the like. So reducing exposure to those two parts of the markets are another way we're adjusting the portfolio, always very mindful of valuations to take account of the trade war. When we look at European companies, we see companies across a broad range of industries which are at very attractive valuations today. It certainly hasn't worked through 2018. 2018 has been a year where the US market, it's come back somewhat in September and October, but the US market has continued to be very strong, while the rest of the world has started to worry about economic growth, worried about Fed rate increases, worry about trade wars and the like. That's taken what we already thought was a significant valuation advantage for European, but also for Asian companies, and made that an even larger advantage. If you look at the valuation of the US market today, it's at a bigger premium than any other point for the last 40 years versus the rest of the world. That's happening at a time when you've already had President Trump put in place the biggest fiscal stimulus outside war or recession that we've ever seen. We've seen the US budget deficit increase already to a level of 5% of GDP. It's almost unheard of to have that happen. That has turbocharged US profit growth this year. The reduced US corporate tax rates fed straight into S&P 500 profits. But it can't happen again. US debt is already 105% of GDP. The budget deficit's already 5%. Italy's having a lot of arguments with the European Union about their level of budget deficit. The level of budget deficit that they want is less than half of the level the US wants. So it's really quite different. Europe overall has a 1% budget deficit versus 5% for the US. So when you think about how much support governments can provide to profitability going forward, much more tilted, much more advantage potentially for companies in Europe and Asia as opposed to the US. So it's really a combination of those, that significant valuation premium for US stocks, the biggest we've seen in 40 years, as well as the fact that the US has sort of peaked out in terms of its profit growth with this budget fiscal stimulus coming from President Trump during 2018.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。